So, good afternoon, everyone, officially. My name is Carrie, and I am part of the programming team at the Westport Library, and it is my pleasure to welcome Tim Baker today for our business program event, Bitcoin and Other Market Trends. Tim Baker is the founder and CEO of Metric Financial and is a registered investment advisor dedicated to helping clients lower costs and improve results through factor investing. Prior to starting Metric, Mr. Baker held product development and strategy roles at several firms, including, among others, BlackRock iShares. There he held numerous roles, including product strategist in the firm's Smart Beta Exchange Traded Fund Group. He graduated from University of Wisconsin-Madison in 1994 with a degree in political science. He is a chartered financial analyst, or CFA, and he has experience in the financial industry dating back to 1996. So we are really honored to have Tim with us today. Just a quick note before I turn the podium over to Tim. Tim will be taking questions throughout the event. So obviously, if you have any questions, we'll have time for that. And for those of you watching virtually at home, welcome. If you have any questions and you're watching over Zoom, please type those questions into the chat and we'll make sure to get to those questions as well. So without further ado, I will turn the podium over to Tim. Thank you so much for being here.
We're doing this on purpose. Okay, good to go? All right, so thank you everybody online. Thank you all for coming. So the topic of this is Bitcoin and other market trends. I'm just going to give a quick little background, not even really go through this item by item. Quick and dirty on Metric Financial, just how to think about this for me as I go through this. This is kind of the anti-financial advisor. So I spent 25 years on Wall Street, more on the investment side than the sales side. And my view of financial advisors, let me over there. Okay, was kind of like, yeah, everybody likes them. They're friendly people, but fees tend to be very high, which bothers me because it has a pretty big impact on people's retirements. And tend not to have a lot of information or knowledge about investments. They just kind of let their home office deal with it, or even worse, a third-party strategist that comes in. So I generally have a different view of the world than most. When I talk to people, I talk about fees and performance rather than, how's your dog doing? Right? Because I like dogs. I'll ask about your kids, but the most important thing is, so I always say, what are the two things no financial advisor wants to talk about? Fees and performance. What are the two most important things to your financial future? Fees and performance. The problem with this industry is there's no transparency whatsoever. How many people here own a mutual fund? How many people here know what that mutual fund costs? Like the expense ratio of each fund. Like your advisor probably doesn't know. So this is something that's near and dear to our heart. We actually just won a client from somebody over fees. They went back to the advisor, said we're leaving because of fees. And the guy said, well, we don't charge fees. I'm like, so that company is now part of the Red Cross. Like this is all charitable. Here's all the fees that you can't see. So I just want to set that up as the framework. I think about Bitcoin a little bit differently. I think about mutual funds a little bit differently. We'll talk about all of that. The three main things we're going to hit here. We'll spend most of our time on Bitcoin. I'm going to talk a little bit about other market trends, flows that we're seeing, things like mutual funds, ETFs. Somebody familiar with an ETF? Okay, yeah, short for exchange traded fund. One of the greatest innovations in the financial industry. And then also one of the big questions that we get is the stock market in a bubble? Are stocks too expensive? Are we headed for a crash? So I have some data points on that as well. Okay. So digital currency. So digital currency, I think what really gets thrown around too much is just Bitcoin, 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 Bitcoin. Maybe every once in a while somebody throws an Ethereum in there or a Shiba, right? Which is, I have an old high school friend from on Facebook that posts some nosebleed chart of Shiba Inu every single day, and I'm like, why are you promoting this stuff to people? But whatever, people are making money. So is anybody, how many people here own Bitcoin or Ethereum or any digital currency? Okay, yeah, and it's obviously done very well, depending on when you bought it. So I also want to address the ETF that came out, and I'm going to explain why it took so long for there to be a Bitcoin ETF. But what everybody needs, so basically we want to think about what it is and then how people are using it. So you can't really understand what it is until you understand the blockchain. Is everybody familiar with that term, blockchain? Okay. So blockchain is basically, think of it as a ledger. So it doesn't have to apply to Bitcoin or Ethereum or any digital currency. It could apply to anything where two people can interact with one another and nobody else can see it. So everything that you can do can be done confidentially over a blockchain. So this could be signing a contract, right? So I use DocuSign for everything that I do with a client gets signed electronically. We don't do paper unless people want to do paper. So you think about places where you can interact with other people seeing what you're doing, and the blockchain, the reason that it's that it has so much focus and attention is it's quote unquote unhackable. So what happens here is I've done this sort of analogy here where you have Sally, Jim, and Paul, you have Tom, Beth, and Sarah, and they're all going to interact somehow, whether they're signing a contract, they're paying one another for a good or a service, whatever it is. The only way for them to interact with one another and get a completed transaction is they each have an encrypted key. So does anybody use like ShareFile or Dropbox, or like one of the things people will use to tell you that something is safe is they'll tell you it's 256-bit encrypted, right? So 256-bit encryption means it's almost impossible to hack. Blockchain takes that one step further and says this person has to have a 256-bit encrypted key, and this person has to have a 256-bit encrypted key. And those two things need to match up in order for the transaction to take place. And the odds of somebody hacking into those matched encrypted keys is like 1 in a billion. So as I'll talk about in a minute, I'm the ultimate skeptic of everything that happens in this industry. And my comment is always, well, it's unhackable until somebody really tries. So right now, there's not a lot of transactions that go through the blockchain via Bitcoin, right? Lots of people using PayPal, lots of people using Venmo. I still use a credit card, believe it or not, right? I mean, most of the transactions are not happening in this environment. When most of it starts happening in this environment, I think you probably get some pretty smart people spending more time instead of, just get a job. I'll figure out a way to hack other people's accounts. And we'll talk about some already hacked. But so basically, if Sally wants to sell Beth a tennis racket, right? Sally's going to ship the tennis racket to Beth, and Beth is going to pay Sally through the blockchain using a digital currency, which we'll come to in a second, but that's irrelevant at this point. It's just a ledger. Beth paid Sally. Nobody knows who Beth is. Nobody knows who Sally is. They just had encrypted keys, 256-bit encrypted keys that matched up. And again, yes. So those are all done through basically algorithms. So every time you open an account, whether it's with Bitcoin or if there was a contract company that was doing online contracts, they would help you create that encrypted key. So the encrypted key, a little bit, will actually come from whatever it is that's happening on this side. So in this case, if she's paying with Bitcoin, Bitcoin is creating that key for both Sally and Beth. It's like if you use Venmo. Okay, gotcha. So yeah, so whatever the tool is that's being used. So if she's going to pay with Bitcoin, and maybe that makes it easier. If she's going to pay with Bitcoin, it's Bitcoin that generates this 256-bit encrypted key, and she, as a receiver of Bitcoin, has to have a 256-bit encrypted key. Those things need to match up in order for the transaction to take place. And the whole idea is, number one, that guarantees the money goes from Sally to Beth, and it guarantees it won't get hacked. My earlier comments notwithstanding, yes. Yeah, so they're randomly generated. Yep. Which is the other argument about being unhackable. If anybody wants it, and I'll leave some cards behind, there's, if anybody's got 20 minutes to spare, it's actually a pretty cool video. It's kind of an animated video about exactly how, not necessarily just Bitcoin, but the blockchain works and the random generation of keys. And it shows, like, as you add more and more bits to the key, the hackability probability, going through like 1 in a billion, 1 in 2 billion. Like if you made it a 500-bit key, the odds of hacking it would be like 1 in 400 billion or something like that, and it would take you 40 years to do it. It's a pretty cool video. Yes. Yeah. Yeah. So if Sally is trying to create that transaction with Beth, this ledger will take Beth's key and match it up with Sally's key. So nobody else's key. So basically, this ledger is identifying that key. So the only way for the transaction to happen is for this central ledger to know this key. So there's obviously an identifier. So Sally knows a way to, and I'm not 100% positive on how because they are obviously keeping it unidentified, anonymous between the two. But there's a way for Sally to identify that she wants that money to go to Beth. And then the ledger, the blockchain, is what matches up those two keys, if that makes sense. Sort of, more or less. Yeah. So obviously there's a ton of technology here. And so, but the whole idea is that it's anonymous. So let me jump to this because it'll help sort of put all this in context. So I think most people were here to hear about Bitcoin and Ethereum and all of that. So this is just the backbone for it. But maybe coming back to that point, the idea behind the digital currencies is there's a little bit of radicalism to it, meaning the whole idea behind why Bitcoin has value, Ethereum, Litecoin, is you're basically, I should put this in bigger letters and bold it. It's a way to DeFi the system, meaning get rid of the central banking system. So you no longer have to rely on, this isn't a bank anymore, right? That can easily identify you. It can be hacked. How many people here have had their credit card stolen or identity theft or whatever? I mean, it happens. The whole idea behind this is it can't happen. But so my big issue with, I shouldn't say issue, I'm pretty neutral on the cryptos. My answer on the cryptos is more like if you want to invest in it, but you got to think about why you're investing it, why do you own it, all that sort of thing. But I have asked many, 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 many smart people, technology, finance people, like, I get what it is. To the question earlier, what is Bitcoin? It is the thing that is generating this encrypted key for them to transact over the blockchain, right? You can't use a credit card to transact over the blockchain. You have to use a digital currency in order to do that. Oops, sorry. But why does Bitcoin have to be worth $17,000 or $60,000 or $12 or $1? Like, why does it have to have that value assigned to it? And the closest I got to an answer that made me even remotely comfortable was the value in Bitcoin is this: the decentralization of our financial system. So think about the fact in our banking system. Does everybody know who Jamie Dimon is? Yeah. So did anybody see his interview a couple of weeks ago? So he was asked a pretty point blank question about his salary. So his salary in 2020, when what do we hit 25% unemployment, was $31 million. And so the interviewer said, "Why don't you take a pay cut?" And so I grew up not idolizing Jamie, but I always liked Jamie because I'm kind of coming full circle here. I did start my career as a very young financial advisor. If anybody here remembers Solomon Smith Barney, I'm dating myself, no longer exists. But he was in charge of the brokerage, the financial advisors at Solomon Smith Barney under Sandy Weil through Citigroup. And Jamie was a very good advocate for the financial advisor, get them better payouts, get them better benefits, that sort of thing. But the answer that he gave to the question was pretty alarming to me. And the answer was basically, my board would be embarrassed if I asked for a pay cut, because it would mean I don't have any confidence in my own ability. The point is, that one person alone makes $30 million. You know, the chairperson of Visa, MasterCard, every other bank in the world. What if you severely limit the need for those banks to be intermediaries on transactions? How much money would that put back into people's pockets? Just the general economic system, the ecosystem in general, right? And so that was the closest I came to a good answer why Bitcoin should have a dollar value associated with it, which I've always kind of said. And by the way, we understand. So the original narrative on this was Bitcoin's going to replace the dollar. And I was like, well, that's interesting because it's denominated in dollars. How do you replace the currency that you're denominated in? So I think that narrative has started to go away a little bit. I think you have less people saying Bitcoin's going to replace the dollar. It's more Bitcoin and the blockchain are going to decentralize the financial system and eliminate a lot of the fat, cost, and what we call friction. So there, yes. No, I'm sorry. That's correct. Bitcoin is it's a cryptocurrency. I'm saying if you could use Bitcoin over the blockchain and get rid of all the banks. Generating what? Oh, yeah. So sorry. It's not like an organization that's doing it. So is everybody familiar with the term mining? So Bitcoin mining. So when you mine a Bitcoin, and by the way, that's one of the reasons that Elon Musk came out earlier this year and said Tesla wasn't going to accept Bitcoin, is because the amount of server power that is used to mine a Bitcoin. So it's all those algorithms. There are actually a finite number of Bitcoins out there. And when somebody goes to use a Bitcoin through what are the other platforms? Coinbase, Kraken. By the way, this is Josh Spooner, my associate. So Coinbase, Kraken, there are all these platforms that you can use when you identify, like you can't just go transact with Beth with a Bitcoin. You've got to be up on a platform like a Coinbase or a Kraken to do it. And Coinbase is the one that asks for the generation of the encrypted key from the Bitcoin that has been mined. Thank you. Give me 1 second. I'm going to come back to that with a vengeance. In fact, that actually yes. What did we decide the number was now? 6,000 digital currency? You guys are all on my next slide. Give me 1 second. So I want to come back to those. But the whole idea behind this, and I'm about to contradict this, is you are eliminating a lot of the friction. The banking system is a huge source of friction, meaning between you and the money that you're spending. So does everybody know kind of the starting APR on a credit card, even if you have good credit? Yeah, somewhere between 11 and 14%. Miss a couple of payments, it'll become more like 16, 17 and have a really bad credit score, and it can go up as high as 25%. That's a huge source of friction, because if you're now in credit card debt, it's almost impossible to pay off your credit card, because your monthly interest and fees is going to be more than the money you're spending on the card. That's a huge source of friction. So the whole idea is, if you can eliminate, and by the way, it's just one source of friction. There are all kinds of sources. But even if you have good credit, how much does it cost to take money out of an ATM? $3, $5, depends on where you are. I actually have a client who yesterday texted me to say, you need to stop automatically withdrawing that money from my Bank of America checking savings account. It has to come from my checking account, because Bank of America no longer services that type of savings account, and I can only do 6 withdrawals per month. And if you take out another withdrawal, they're going to charge me $10 to do it, which is just, so that's what I mean by friction. Coming back to both your gentlemen's points, what are the challenges to all of that? Difficult to mine and expensive to transact. So this comes back to the point of Coinbase making money and Kraken making money. Did anybody see the ad? It was recently during some big sporting event, might have been a Monday Night Football, for crypto.com. And it had, what's his name, Matt Damon, walking around. And the last words of it were borderline offensive to me, because he was like, the future favors the bold, or whatever it was. And it was like, you just blatantly encouraged people to invest in cryptocurrency without explaining anything about cryptocurrency to them. It basically was like, buy crypto, but whatever. There are going to be more and more platforms that are available for you to transact using digital currency and to trade digital currency. And so who saw Robinhood stock, Bitcoin really started, the trading in Bitcoin really started to slow down, and Robinhood stock tanked, because basically people were like, that's a huge percentage of Robinhood's revenue base, is the money that they make on the transactions, buying Bitcoin from you and selling it to me, right? Everybody's familiar with a bid-ask spread on a stock or an ETF, right? TD Ameritrade buys it from me at 40, sells it to Josh at 40.05. They keep 5 cents, right? So it does get expensive to transact. And what most people will say is, but I can buy and sell my Bitcoin on Coinbase for about 0.5% per transaction. And my answer is always, if you leave it on Coinbase, if you leave it on Kraken, try to take that money out and put it in your bank, and it's going to be anywhere from 1 to 4% of the value of that transaction. So that's expensive. It's not 15%, it's not 25%, but it sure as hell isn't, frictionless, right? That is a source of friction. It's going to be a deciding factor in whether somebody wants to convert their Bitcoin into dollars or not. Very high carbon footprint. So again, going back to Elon Musk, who, it was interesting, decided in March that Tesla would not accept Bitcoin to sell Teslas because of the high carbon footprint, how much energy it takes to generate the algorithms to create an acceptable Bitcoin. And then I guess it was in June, a couple of months later, he said, yeah, we're going to accept Bitcoin. And then he was touting Dogecoin and then slamming Dogecoin. And sometimes I just get the sense these billionaires wake up and they're like, who can I screw with today? Like, what can I do to the market today? But it does have a very high carbon footprint. It is massive, massive amounts of server farms that are required to generate these algorithms. The other thing that I think gets talked about far too little is central banks. If you're going to call Bitcoin and the blockchain a way to decentralize the financial system, is there anybody nuts enough to think that the central banks around the world, the Federal Reserve, Bank of China, are ever going to allow these things to be completely unregulated? And the number one reason is, right, what does the Federal Reserve keep saying? Is blockchain and digital currency is going to be a way for people to launder money, right? And so we need to regulate it because nobody launders money now. So we got to stop Bitcoin before people can launder money. Right, but so Turkey banned Bitcoin and came up with its own digital currency. China has really cracked down on transactions in Bitcoin. Mexico, I believe, just put a lot of restrictions on transactions in digital currency. Interestingly, the head of the SEC just came out and said the US will not ban it. But the Federal Reserve has been pretty clear, we are going to regulate this. Oh, interesting. Okay. Yeah, so central banks are absolutely going to want to regulate it. Truly unhackable. There was a company about 3 or 4 months ago that reached out to somebody that had hacked into $600 million worth of Ethereum and was basically just holding it ransom. And then they worked out a deal and they released the 600 million. It's not really unhackable. It's really more in concept because of the complexity of the encrypted keys working over the blockchain, that it's considered significantly less hackable than a credit card or Venmo or, whatever, PayPal, whatever the vehicle is. And then we get more into sort of the investment piece. I mean, I assume we're all familiar with the volatility of Bitcoin on a day-to-day basis. I mean, it's remarkable to me. Like, the thing can just drop 3%, but nobody pays any attention. If the S&P 500 drops 3% in one day, people would be like, "What the hell happened? Like, did the Federal Reserve raise interest rate?" People would go nuts. But 3%, nobody blinks an eye. Yep. Yeah, so that actually gets to um, where did I have that? Well, I'll just address it now. So it basically boils down to, this is one of the themes I talk about with digital currency is, are you owning it as something that you're going to make money on? Meaning, I'm going to buy Bitcoin at 60,000. I'm one of these believers that it's going to 250,000. I'm going to take my money and run. Or are you owning it as a currency that you can transact business in? Because at that point, it doesn't really matter whether it's volatile or not. Because obviously, with Bitcoin at a price of 60, where's Bitcoin today? 60, 65 today? Oh, 60. Yeah, that's what I thought. I was like, went up 5,000 again today, right? No big deal. Just went up $5,000. No biggie. Yeah. Yep. So if you had, let's say an Audi cost one Bitcoin. Let's say an Audi's worth $60,000, and it's worth one Bitcoin, and Bitcoin falls to 50,000 tomorrow. Well, now the Audi is just worth more than one Bitcoin, because obviously there are going to have to be fractional shares of these, of Bitcoin or Ethereum. So it would be worth, like 1.1 Bitcoin. So it would be fractions of Bitcoin. And if the price of Bitcoin went to 70,000, it would be worth 0.85 Bitcoin or whatever it was. So they're obviously going to be, they'll take fractions of a Bitcoin. So the person using it so this is what I said to my friend who, I forget if he said I was irresponsible or not forward looking. for not owning Bitcoin. And I was like, look, Rick, there's a difference between why you're buying Bitcoin and why I would ever own Bitcoin. You're owning it because you're speculating that the price of Bitcoin is going to go up, and you don't own anything. You don't own a Bitcoin. You're not a miner of Bitcoin. You're just buying it through this ETF or GBTC. Everybody's familiar with GBTC, Grayscale Bitcoin Trust. So that was kind of the original way you would buy Bitcoin. It's like an ETF, but it's actually set up as a trust. They do have a little bit different structure, but that was what he owned because he thought the value of GBTC would go up because the price of Bitcoin was going to go up. If I was going to own Bitcoin and I was being, as you say, forward looking, then that means I envision a future where transactions take place in Bitcoin, not dollars. If that's why I own it, I don't care what the price of Bitcoin is. It's not going to affect the ultimate value of the product that I'm buying. It just affects whether or not I'm going to make money on it. So the person at Starbucks or the Audi dealership or wherever, they're not going to worry about the volatility of the price of Bitcoin because they'll just adjust the dollar value of their product in Bitcoin. But so this is what I was saying about the earlier narrative on Bitcoin was the narrative was originally, this is going to replace the dollar. And I'm like, that to me makes no sense whatsoever. Because the whole reason the dollar and the euro are two big standard currencies for the world, for the global economy, is because they're stable. They have very strong banking systems that back them, very strong economies. Right? There's a reason we don't use I was about to say the Bavespa. We don't use the yuan as the global currency standard. We don't use the peso because they're volatile, and nobody wants a volatile currency. The thing that attracts you to a currency is stability, right? Why do people buy bonds? Which there's no point in buying a bond these days, but most people are like, I don't buy bond, which is good. That's a good thing. But right, so some people do use them because they have a more stable value than a stock, right? So yes. No? Yeah. Yep. Yeah. Right. Yeah. 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 So the obvious answer to the question to me is math and technology, right? So the reason there's a finite number of Bitcoin is because of how long it takes, the technology that it takes to generate the 256-bit encrypted key for two people to match up. But right, so think about the semiconductor industry. The ability of a semiconductor 35 years ago, but everybody's familiar with Moore's law, right? Every year, semiconductors don't they don't get more powerful linearly. It's exponential. And so there's no reason to believe that someday there won't be a limit to the number of Bitcoin, or there will always be a limit, but that limit will increase as the technology gets better. And it becomes easier, not easier, but the power of the servers that are generating these algorithms get faster and better. So there may always be a limit, but the limit might keep increasing. I know that sounds contradictory, but what I mean is, in one given period of time, you'd be limited to 21 billion. Then you might be limited to 22 billion, all based on the technology map. In other words, that's what we're talking about. Yep. Right. It's exactly what I'm saying. Right. It's only limited now by the confines of the probabilities or the ability to generate these encrypted keys before they will eventually be able to produce more. Bingo. So that's my point about Moore's law, is the ability to mine a Bitcoin was easy in the beginning because of the numbers. When you had one Bitcoin, there weren't that many of these encrypted keys. As you create another Bitcoin, now there's more. Another Bitcoin, now there's more. So my view of it would, well, so each Bitcoin has to have be able to generate these encrypted keys. And so if you have more Bitcoin generating more keys, yes. I mean, I think it's only limited by the math of it, right? It just, the same as it's difficult to hack, it's difficult to generate more and more keys because each key has 256 numbers in it. So I agree with what you're saying, which is eventually you just need technology to catch up with the numbers, like a semiconductor. So are we really limited to 21 billion? Or is the ability to generate new Bitcoin just slowing? Right. But that's what I'm saying. Do we get better and better technology? Yeah. 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 I want to come back to that point. Josh, you had a quick point, and I want to. Yeah. 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 Right. It's an identifier. Yeah. Yes. And then we do a transaction, it generates another key. Yeah. Yep. That they won't, they won't. Yep. Yep. That's a good point too. Yeah. Yep. Yep. That's true. So there are different limits on Ethereum and Bitcoin and Shiba Inu. Like there's different limits on all the different cryptocurrencies. But I want to come back to what you had said about improving everybody's life. Like, how does the bank bail out the system if they can't just print more money, raise or lower interest rates, whatever that is? So on the face of it, the Federal Reserve is going to say, we don't want Bitcoin to go unregulated because it's going to be used for money laundering. Like, all right, we're helping the Nicaraguans launder money. We're helping Pablo Escobar launder, but like that's not a good reason, right? What they don't want is rampant inflation, things to get out of control. They like to be able to control what is happening in the economy. And right or wrong, 2008, 2020, right? Like could have been disasters, right? And the Federal Reserve stepped in and people were able to keep their jobs and so on and so forth. I'm with you on that one. I absolutely 100% with you on that one. But that's my conspiracy theory is it's just never going to go unfettered. Yeah. Yep. Yep. Yeah. 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 Digital currency. So let me come back to that because I know we're at quarter to two. What are we scheduled for? Two. Okay. Lightning round. Um, okay. No more questions. No, I'm just kidding. Right. So which digital currency? We already addressed that. There's thousands of them out there. Power grid, similar to the high carbon footprint. But so I want to come back to the comment that I made earlier. You have to think about why you're owning it, right? Am I owning it because I think I'm going to make money? So for the people that own it, who owns it because they hope it's going to increase in value and they'll make money on it? Okay. And how many people own it because they just use it to transact and they believe that's the future of transacting? Yeah. Okay. So on the investment side, I'll hit that first. Is it speculation or investment? Would you consider it speculation or investment? Speculation. Speculation. Okay, good. So, but that's my point, folks. We don't use Bitcoin in our portfolios. We don't recommend it to people. But if you're aware of what you're doing, like my friend who owns it, he doesn't have anything in there he couldn't afford to lose. Although, when this happens, you sure? Because you put 10,000 in, you could afford to lose that, but now it's worth 60,000. Like, should you be readjusting how much of your portfolio is exposed to? But anyway, so it's speculation or investment, volatility. So why was there a big delay? It took over 6 years for the SEC to approve BITO, which is the ProShares Bitcoin ETF. And I don't want to get into too many details because we are going to start bumping up on time. But the only way the SEC would approve it was if it traded Bitcoin futures, not actual Bitcoin. And the reason for that is the futures market is a lot more regulated than the physical market. So basically, what the SEC is saying is we can't really control Bitcoin. The only thing we can do is control what gets traded inside of the ETF. But the whole reason it took them forever to approve a Bitcoin ETF was because of the volatility. And I'm going to give you some data in a second to talk about that volatility. So basically, like, don't put this tool into investors' hands because they don't know how to use it. You know, basically the SEC was like, this is like giving a hatchet to a 3-year-old. Like, what are you doing? Taxes, you know, it's obviously when you transact in Bitcoin, Ethereum, whatever it is, and you're doing it for investment purposes and recirculating back into dollars, there are obviously capital gains associated with that. How do you fit it into a portfolio? We kind of addressed that already, which is just think about what you own or don't own. The other thing I'll send anybody who wants it is the last time I did this presentation, I circulated, because I always like to have, hey, it's not just me, like somebody else said this too. There's a good like 2 or 3 page paper on why when you own Bitcoin, you really own nothing. You own the promise that somebody else might buy it from you in the future. So think about, do you want this to be a significant portion of your assets that could potentially, right? So, right, if we're thinking about it denominated in dollars, and to your point about if I'm a Ford dealership, like why would I accept this Bitcoin as a currency when it's so volatile, right? What if someday just the exchange rate between Bitcoin and a dollar is $1? Like, what if that's the thing? So, you know, just be aware of what it is. Which one do you want to own? So Bitcoin and Ethereum have obviously what looks like very similar return patterns, but you can see that there are slightly different sub patterns within the pattern. And which one do you really believe in? So, I mean, everything that I've read says that Ethereum, when you think about what you want the characteristics of a cryptocurrency to be, unhackable, you know, good for multiple kinds of transactions in multiple kinds of industries. Ethereum actually has more characteristics of that than Bitcoin does. Valuation, this is the big thing to me. So how do we value a stock? Does anybody know the numerator and denominator we use to value the stock very commonly? Future price to earnings, yes, there's a million different ways. That's what I used to do for a living, and cash flows was a big piece of it. But most of the world thinks of it as price to earnings, price to cash flow, price to sales, whatever it is. So what's the PE ratio of Bitcoin? It doesn't have earnings. It doesn't have revenue. It doesn't. That's what I mean. Like when I say you don't own anything, when you own Tesla, so why would I pay 1,000 times earnings on Tesla? Because Tesla's doing amazing things. I think 10 years from now, Tesla's going to make a ton more money than they do now. Why would I invest in Apple at 35 times earnings? Because Apple's proven that they can continue to go there. With Bitcoin, I just have no way to put a value on it. So traditional valuation, right? And that may be one of my shortcomings. Is I did spend 25 years doing financial statement analysis and investment grade bond, corporate bond research, and you know maybe my friend is right. Maybe my mindset is too limited to think about why this has value. But I am pretty confident that you really don't own anything other than the promise that somebody else might buy it from you someday. And then how to buy it, we talked about that already. Coinbase, Kraken, there are costs associated with it. And folks need to have their eyes open about that. Because somebody who came to the last Bitcoin luncheon that I did on this, I made the comment about it costing 4% to transact in Bitcoin. And she sent me a screenshot of her Coinbase account where it said 0.5%. And she's like, this is what we pay. And I'm like, well, right, but you haven't tried to convert that back to your bank account yet. So when you try to take it off Coinbase, then they're going to charge you to leave, just like Bank of America for withdrawal fees. Okay, so volatility. Listen, especially for people that own it, there's no way for me to argue that these digital currencies have not had phenomenal returns that absolutely dwarf what you would have earned in any stock market. You know, Tesla, you know, returns don't stack up to a Bitcoin or Ethereum. My point here is when you think about the volatility, why does the volatility matter? Because it can impact behavior. So folks that own it and can deal with stuff like this, you know, buyer beware. You're aware that you might lose it. You're aware that you might make double your money, whatever it is. But for a lot of people, so I worked with a guy, and obviously I come from the financial industry a few years back that bought Bitcoin at 15,000. It went to 19,000. It went to 9,000, and he bailed. And that's why the SEC doesn't want people investing in this type of thing. And this is what I talk about here. So this is volatility of returns. This is the Bitcoin trust. This is the Ethereum trust. Grayscale has one for each, both Bitcoin and Ethereum. This is the volatility of the S&P 500. So I don't know if anybody loves or hates him, whatever. I was listening to Howard Stern one day, and somebody called in, and they were talking about how one of Howard Stern's employees buys Bitcoin. And the person called in and was like, "Are you nuts? Are you out of your mind? Like, why are you investing in this stuff? It's so volatile." And the guy's response was, "So are stocks. It's not even the same planet. I mean, this is 80% volatility. This is almost 100% volatility. This is less than 20% volatility." So where I'm going with all of that is, so in our industry, one of the things that we think about a lot is Sharpe ratios, which is basically take your return and divide it by your volatility, and that gives you your risk-adjusted return. So as much as these have dwarfed the S&P 500 in terms of total return, your risk-adjusted return isn't that much different. So I only say that to people because be aware of these patterns, right? Like this was the one that I kind of joked about. Like between April and July, Bitcoin lost about 50% of its value for really no apparent reasons. Anybody know how much the S&P 500 was down at its worst during COVID, March of 2020? So the S&P 500 from peak to trough was down 35%. And why did that happen? Global economic lockdowns, people out of work, right? And not everybody was treated the same, which I'm jumping ahead, but technology companies did phenomenally well. Energy companies did horribly. But if the S&P 500 went down 50% in 3 months with no reason whatsoever, like we'd be burning buildings and, you know, looting each other's houses. It just, but you know, a lot of people don't even blink at it. So, well, right, bingo. And there's also, it also comes back to my earlier point is there's something in the S&P 500. You own a company that generates revenue and earnings. So if that falls 50%, well, then there must be something wrong with those companies because the market tends to know better than the analysts, which if anybody wants to come for another lunch and I'll talk about analysts for 2 hours. And I used to be one. Anybody want to talk about this? I don't even update this slide anymore. The meme stocks. Who cares? I just think it's funny. Free popcorn and everybody bought the stock. By the way, you talk about Wall Street, like free popcorn. The CEO says free popcorn and free tickets. And then the stock pops. And the next day, AMC Entertainment comes out and says, we're going to sell $18 million of our stock in a secondary public offering. How that's legal and the SEC didn't shut that company down is just unbelievable to me. But again, it's manipulation of the retail investor. If CalPERS got caught up in that, the SEC probably would have shut down AMC Entertainment because CalPERS doesn't, you know, as a $100 billion pension fund, does not want to get caught up in that kind of thing. Okay, so I'm going to move on. We'll go through these pretty quickly. So our stock's in a bubble. I just try to remind people that even though CNBC never talks about it, there are countries out there that have stocks besides the US. And the US has absolutely crushed other geographies for years now. The S&P has been one, other than cryptocurrency, the best asset class globally. You can see emerging markets actually had a pretty nice bounce back last year. This is for the full year of 2020. That has not been the same during 2021. So as we have recovered, I use air quotes for recovered from COVID and that market environment, the USA has really separated itself from non-US developed. So EFA stands for Europe, Australia, and Far East. So developed countries are kind of hanging in there. Emerging markets, which started out the year strong, have plummeted recently. And if you're paying attention, it's fairly obvious. China's obviously got some concerns with COVID lockdowns. And if you don't know, China makes up 40% of emerging markets. I get the question all the time, why is China even considered an emerging markets? It's the second largest economy in the world. How you get characterized, which index you go into, isn't necessarily driven by the size of your economy. It's more the policies, procedures, structure that's in place. But what's the point of all of that is, and this is fairly noisy, but you can really see it over here. So if you look at the expensiveness of U.S. stocks compared to other international stocks, you can see that compared to before the pandemic, the U.S. is still way more expensive than emerging markets and significantly more expensive than non-developed U.S. So this is all just, back to your point, this is all just price to earnings ratios for these different indexes around the world. So are there opportunities somewhere else? And I sort of had this idea to create this slide because somebody made a comment on social media that stocks are insanely overpriced. And I was like, what do you mean by that? What's insanely overpriced? And he's like, the S&P 500. And so my comment to him was, talking about the S&P 500 is like talking about the weather on planet Earth, right? So there's 11 different sectors within the S&P 500, and they did not fare the same during COVID. So 2020, technology stocks were up 40%. Energy stocks were down about 37%. There was a huge chasm between the winners and losers. Does anybody remember what Zoom stock did when we started the economic lockdowns, right? And what's it done since? You know, it's almost like, well, reversion to the mean, like you did phenomenally well, you know. So it's important to think about how these all get impacted and where your opportunities might be. So your two best performers in 2020 were technology and consumer discretionary. And by the way, be really careful about these sectors because CNBC just refers to all the FANG stocks as technology. And one of them is a technology stock. So I'm sure you all know FANG stands for Facebook, Amazon, Apple, Netflix, and Google. Apple is the only technology company in there. Consumer discretionary, Amazon makes up 44% of the consumer discretionary sector. Facebook and Google together make up 44% of communication services. And if you change it to FANG and include Microsoft in there, then you have two technology companies in there. But so that's why a lot of these companies did really well too, because they're technology-like. But then if you come year to date through the end of September, all of a sudden these best performers aren't looking so hot. And all of these ones that got crushed, energy and financials, have done significantly better because everybody believes that once the economy starts to open up again, you will get better performance from these types of companies. Do you have a question? Oh, sorry. I moved on to the second of our topics. So I switched over to our stocks in a bubble. Yes, no. So So what I meant on that one was BITO was the ETF that tracks Bitcoin, but the SEC approved one that trades futures, not physical. because the futures market is more regulated. But I moved on to a different topic. Yeah, sorry, you must have been like, what the hell is this guy talking about? This was like, where did we go? Are there opportunities elsewhere? Yeah, if folks have to go, that's fine. It creates opportunities between growth and value. So if you're a growth investor, if you're a value investor, look at this gap, by the way. This has never happened before. Growth stocks in 2020, up over 35%, value stocks up around 1. That's the biggest gap you've ever seen between growth and value stocks. And look at what happened since. So year to date. And by the way, this gap would be even bigger if you look at from the moment Biden won the election and we had the vaccine. That was the moment when value stocks completely replaced growth and technology stocks. And so that gap would look even bigger. But just for ease of view, I made it 2020 versus 2000 year to date 2021. It's important to think about like, are stocks in a bubble or are US stocks in a bubble? Are stocks in a bubble or are technology stocks in a bubble or is growth stocks in a bubble? Value stock, right? It's not just one thing. Unless you're buying VOO, which is an S&P 500 ETF, then it's all one thing. But there are huge component differences. And actually, back to the whole FANG thing, back in 2019, when you had that significant market rally coming into the end of the year, there was an interesting stat on CNBC that 95% of the S&P 500 return came from those 5 stocks. So that's the problem to me with a market cap weighted index, is owning a stock because it has a big market cap is completely arbitrary. We always have the S&P 500 as the core of our US and emerging markets as the core, but we build these factors around them, which I'll talk about in a second. Kind of the punchline here, stole this graph from JP Morgan, which I absolutely love. So we've talked about price to earnings ratios. And one of the things I talk a lot about, and I'm getting ready to do a video on this that I'll post on social media, is what really drives stock prices. So I had a client come to me about a month and a half ago asking to take everything out and put it in cash. And I was like, okay, let's talk about that. And their concern was they hate, I won't name anybody, certain politicians in Washington, D.C., and their job is to destroy the stock market so that they can get in and buy cheap and then do whatever they do to make it go back up again. She was concerned about debt ceiling, all of those things. And I'm like, but that's also short term. Think about COVID, the worst pandemic this world has ever seen, that lasted 5 weeks, right? The worst pandemic, global economic lockdowns, which, I'm 49, but I've never seen a global economic lockdown. Like that to me was just nuts. So what really drives stocks in the long term is earnings. And when people look at how the S&P 500 has done this year, right, up about 15%, that's just the price return. The earnings growth has been 26%. So if you're watching earnings reports on a quarterly basis, companies have blown it out of the water. And it's not Amazon and Google, it's JP Morgan and it's Carnival Cruise Lines and Delta Airlines. It's a lot of these quote unquote recovery stocks that have had really good years from an earnings perspective, bearing in mind we're coming off a really ridiculously low base. So it's almost like, yeah, I had 200% earnings growth coming from 0. You did. It's like the big debate now is inflation. Right? Is inflation going to be a huge problem because the numbers have been really hot this year? Well, that's because there was negative inflation last year because of global economic lockdowns. So I keep telling people, like, let's get to a semi more normal environment before we start evaluating things that are very short term. But so anyway, my point is, if you look at the actual price to earnings ratio for stocks, the short answer for folks is, well, they're actually not more expensive than they were last year. So you could have made the argument that they were in the bubble last year, but they still went up another 16% this year and still got cheaper because earnings were higher. Okay. So industry trends, this is kind of near and dear to my heart. As Carrie mentioned, my last job prior to starting this company was in BlackRock's ETF division called iShares. I worked in their smart beta group, which is really factor investing. And this is my mission. So there is $20 trillion in actively managed mutual funds out there. And it's just, that's all the money I want to leave those actively managed mutual funds for reasons I'll talk about in a second. But this slide came up because we worked on a new client for about a year. And interestingly, the client just decided to move. They were with their brother-in-law and decided to leave the brother-in-law as an advisor, which I sort of took to heart. But when he went back to the advisor to explain that he wanted to pursue this ETF strategy, the writing's on the wall. This is flows between 2011 and 2020. Almost $3 trillion has gone into ETFs, and less than 500 billion has gone into mutual funds. And I'm going to get into more detail on that. But more importantly, whether it's an ETF or a mutual fund, do we want to track an index or do we want an active manager like American Funds or Fidelity or MFS, whoever the fund company, T. Rowe Price? Do we want an active manager or do we want to track an index? About 3.7 trillion has gone into index focus. And again, about 500 billion has gone into actively managed. So this kind of makes it look like mutual funds and active management is still alive. So let's look at stock funds. Let's get rid of bond funds and allocation funds and all of that. Let's just look at stock funds. Over the last 3 years, $800 billion has gone into ETFs, and mutual funds have lost about $900 billion. Again, this is just stock funds, US stock funds, international stock funds, sector funds, all of that. So I put up here, stock fund money is literally walking across the hall from active to passive. Look how closely these two charts mirror one another. This is ETF. This is ETFs taking money from mutual funds, and this is passively managed taking money from actively managed. So the issue that I had was when my client went back to his advisor to say, I'm pursuing ETFs, I believe this is the way of the future. The advisor's response was, ETFs are new, ETFs are unproven, and ETFs are volatile. And I said, well, the first ETF was launched in 1989 by State Street. And they launched the first ETF ever, which was SPY, that just tracks the S&P 500. There are now, just in the US, about 4,600 different ETFs that have taken almost 3 trillion over the last 10 years. And particularly in the stock space, that's where all that money is coming from. And as far as whether they're volatile, it depends on what they track. If you had an S&P 500 mutual fund and an S&P 500 ETF, they're going to have the same volatility with one another. It depends on what's inside of the ETF. And as far as whether or not they're unproven, again, I would argue the amount of money going into them would dictate that they are very much proven. So why is this happening though? Because most people, I've had mutual funds forever. They're great. My account keeps going up in value, right? So they're fine. The question is, should they be doing better? So this is the comparison of an average A-share mutual fund versus an institutional share class compared to ETFs. So we invest in factors, conversation for another day, and a market ETF. So this is the S&P 500 ETF that costs 0.03% to own. It's basically free to invest in the market, right? So, I mean, the costs of mutual funds just dwarf ETFs. Tax costs for anybody that owns a mutual fund in a taxable account, meaning not an IRA or a Roth or anything like that. This is something that BlackRock put together. Hypothetical growth of $1 million over 10 years. If you have no tax costs, ETFs don't have no tax costs, but they have very, very low tax costs. If you have 0% tax costs, your money grows to a little less than 3.15 million. If you have a 1.7% tax cost, which is the average tax cost of a mutual fund, you gave up almost $500,000 just in taxes. Does anybody own a mutual fund in a taxable account and get a 1099 every year? Yeah. So they send you a 1099, whether you sold anything or not, you got to pay a tax bill. More importantly, at the end of the day, I don't think anybody would care about this if it wasn't for this. So this is Standard & Poor's, same people who put together the S&P 500. They compile a study every 6 months called the SPIVA study, Standard & Poor's Index versus Active, and they compare all active mutual funds, stock active mutual funds, to their relevant Standard & Poor's benchmark, like the S&P 500 or the S&P mid cap, whatever it might be. This the percent of large cap managers that underperform the market over a 20-year period. It's 90%. Like, how does nobody know this? And the reason nobody knows it is because financial advisors sell these things, put them into accounts. Clients ask, how did I do? Great. Your account was up 8%, but the market was up 9.5%. But most people don't respond to that. Great, I earned 8%. I'm very happy. So the question is, if you had just been invested in, the market, would you have done significantly better? And, I'll talk, some other time, I don't know, maybe Carrie and I will put something together on what factors are, right? And if you look at the factors, they actually have a strong tendency for beating the market in the long run. So these are just 15-year returns. Obviously, this value number here doesn't look so hot. I'd take it out of the chart, but that would be non-transparent and deceptive. Value, actually, if you think like a 1-year number can't have a significant impact on a 15-year number, this is kind of your proof. I showed you the gap earlier between growth and value, and that has really hurt the 15-year numbers. I'm a believer that it'll come back. But so that's why all of this money is leaving, is people are starting to get the picture like, man, these things are super expensive and they don't even do what I'm paying them to do. It's like buying a Jaguar and somebody gives you 2 wheels and a pedal. Like, this is not what I paid for. So that's kind of why the money is leaving. And then the last trend that I talked about is, and the reason I started the company is, it's unbelievable to me that the traditional advisor fees have remained as stubbornly high as they are. The average fee continues to be almost 1.25%. And the problem is that this has been around for 40 years. So everybody goes, yeah, well, that's the industry average. That doesn't mean it's right. I mean, the average way to buy a book was to go to Barnes & Noble 20 years ago. And then Jeff Bezos said, there should be a cheaper way to buy books. Yes. Thank you. You're coming to my next presentation with me. So that was where I was going to go as well. So obviously, and sorry, Carrie, I'm not trying to do this as a pitch or anything. I'm just trying to illustrate. So I got asked the question the other day, how can your fees be so much lower than a regular financial advisor? So if you work for Ameriprise, Edward Jones, Merrill Lynch, Morgan Stanley, LPL, any of these companies, if you're a financial advisor, you have to share those fees with the firm that you work for. So one of the folks that I met yesterday on a networking call, he doesn't work for MassMutual, but he's plugged into MassMutual as a broker-dealer, meaning they do all of his transactions for him. So he has to share his fees with MassMutual. So what am I going to do? Well, I'll charge higher fees so that what I share keeps what I want in my pocket. So we're completely independent. We don't have a broker dealer. Everything we do, as I noted earlier, is through TD Ameritrade. So we keep what we earn, so we don't have to share it, so we can keep our fees lower. And I've made that argument to folks before, is you used to be able to deduct your investment advice fees from your taxes, and now you can't. So part of people ask me like how you arrived at this number. It's partially because if you take the cost of a robo advisor, like a Wealthfront or a Personal Capital or whatever, and their base fee is going to be like 0.25%. But then if you want the advice of a financial consultant, which by the way, it's going to be somebody that's 23 years old and just graduated from college, right? So watch the advice that you get. But so if you want financial advice from that Personal Capital, or now they're going to charge 0.5%. And if you want trust and estate consultation, it's going to be 0.75. So I basically said, all right, I'll solve everybody's problem. I'll give you a non-robo advisor. I'll give you a CFA with 25 years of experience, and we'll help you with trust and estate planning and tax and all that stuff for the same cost as robo. And at a 36% discount to the traditional advisor fee, now we're basically the same as getting your tax break back on the investment advice. And by the way, this is why we do it. It keeps more money in people's pockets. I'm not Robin Hood. I'm not trying to save the world. I have a mortgage too. I'm trying to make a living, but there's no need for some of these fees. I mean, the hedge fund managers are the one that own beach houses, not the everyday people. I mean, they're the ones who make out from their investments. So that's all I had on that. So just final thoughts on crypto. It should not be intimidating term. By the way, thank you guys, everybody online and here for coming. This is a very popular topic. And I think mostly because people are really trying to get at what it is. And it really is just, and Josh probably clarified better than I did, how the whole keys things work. But it's kind of like Venmo or your Starbucks app. It's just better encrypted. So if you have, your Venmo app, basically, like I send you $20 and then you move the $20 into your bank account, or you leave it on Venmo and pay somebody else $20. Right. The only difference is the level of encryption and the complexity for the technology. My personal view, it's not what is cryptocurrency. Like cryptocurrency is basically the electronic version of the dollar, however you want to think about it. It's why is it worth $60,000? Why is it worth $60,000 now when it was worth $35,000 3 months ago? Right. So how do we adjust that value? We don't recommend it or use it in our portfolios, but we know some people want to own it. So we do have those discussions with folks. We basically just say like, look, open an account with Robinhood or Coinbase or whatever, do it over there. We'll give you consultation on how to use it in the portfolio, but I wouldn't touch that liability with a 10-foot pole. And then, yeah, just that's kind of more the narrative on metric, keeping fees low and beating the market wins in the long run. So kind of summary of everything. Decide if you're owning Bitcoin to spend money or make money. Stocks are not one thing. It matters whether you're thinking about growth or value or technology or oil or US versus non-US. The US may deserve a quality premium. It's always going to be more expensive than emerging markets in Europe. It always is. But how wide does that gap have to be? And does it create opportunities for other geographies? Be discerning when you hear the media talk about tech stocks. Amazon is not a tech stock. Google is not a tech stock, right? So it's really important to think about how these things are really getting allocated. Growth will obviously always be more expensive than value. But as I was pointing out earlier, it is pretty close to an all-time record. And then, yeah, it's difficult, right? The challenge with advisors is people have long-term relationships. And so, I'm just going to leave this alone. So I kind of call it the quagmire, just kind of a new way to think about things. So I don't really have anything else? Were there any other, did you have questions from online? Okay. Yep. Okay. Yes. So whoever needs that, I either need their email address or I can send it to you and you can forward it along, however you want to do that. Okay. But I wanted to, anybody in this room, any other questions, thoughts, comments? Yeah. Yep. So GovCoin, that, I mean, there's so many things we could have gotten into here that we didn't. So is anybody familiar with stablecoin? So stablecoin is kind of like the digital version of a money market fund. It's designed to keep its, so think of it like I own Bitcoin in Coinbase. I don't want to own Bitcoin anymore because I think it's going to go down. So I'm going to put it into stablecoin. That'll hold its value. But I absolutely think that if this is going to be successful, digital currency in general, I think a lot of countries will have their own currency. So GovCoin, I've got to dig it up. I'll find it if you want. There was an article from The Economist. I thought I forwarded that to you. It was maybe a month, maybe I didn't. I spend most of my evenings like scrolling through like all my Facebook feeds from The Economist and Wall Street Journal, and then I take those and I forward them to myself as an email, and then I get up at 5 o'clock in the morning and read them. But so there was an article by The Economist. In fact, it was their cover story article about GovCoin, and this is coming. And so again, I try very hard not to be negative about Bitcoin because I don't, first of all, I don't want to shape other people's opinions on it. I just want to give people data and then you decide what you think of it. But I do think that's one of the major threats is like people have this euphoria. I was talking on a presentation that I did yesterday about behavioral finance and anchoring and all the different and benchmarking and all of those things. And people do tend to fall in love with winners. And so they get very caught up in the fact that, well, I bought Bitcoin at 19,000. Now it's at 60,000. Why would I ever sell it? It's the only thing that's working for me. And actually, that's what a friend of mine said to me. And I'm like, only thing that's working for you? Your stocks were up 20% last year in a global economic lockdown. You know, that to me is working. And they're up another 20% this year. But so I do think that's one of the big threats. I kind of, and I hate to use this analogy, but nobody's ever accused me of not being direct. I kind of look at it like the movie Caddyshack when all the caddies are allowed in the pool from 1 to 105. And so they're all playing around, and then eventually they all get kicked out of the pool. I kind of look a little bit warily at things like Bitcoin and Ethereum, and I go, when does GovCoin come and just knock these guys right off the post and go, hope you guys had fun, you know, trading this thing, but now we're replacing it with something that we can regulate but still offer you all the benefits. Yes. Owned by PayPal also. Bingo. Yep. Yeah. Yep. No, so sorry, that's the world I come from. So I'm very familiar with that phrase. And also Warren Buffett's, you know, be fearful when others are greedy and greedy when others are fearful. For sure. I mean, that was kind of my point earlier I don't, yeah. So listen, my bank account is no safer than Venmo, but when somebody pays me on Venmo, I move it to my bank account. Thank you for coming. And maybe I'm no safer there, but it's the known universe to me. I don't know what is happening on Venmo. Has anybody ever tried to ask a question on Venmo? Oh, okay. Like I've tried to get help with certain things on Venmo, and there's like nobody to contact, and I'm just like, what is going? It was like an empty, dark room that you walked into. You're like, I just want to get out of here. Like, I'll take whatever's in the room, and I got to get out. So, but yeah, that is. So here's the way I think about Bitcoin, Venmo, Starbucks app, everything. Everything is a new place to potentially get hacked. The only thing that's not going to get hacked is the money under your mattress. but there's always such a thing as a break-in. So there's really no way to protect your money. Sleep well, everybody. No. But yeah, I mean, everything's a new place to get hacked. The technology is just too strong for people that, right? I mean, you could make the argument that there's more money backing the people trying to hack than there is backing the people trying to protect it. Yeah. Yeah. You know, interesting last tidbit for you for talking about sectors. For people that don't know this, if you go to look at all the different sectors of the S&P 500, two of the biggest companies in technology are Visa and MasterCard. They are not considered financial services companies by a sector evaluation. They're considered technology companies, AKA hackable. Yeah. Yeah, NFT is really weird to me. Like, it's this obscure like conversation that just branched off of Bitcoin. Right. Right. You have a tangible, you know, object that comes out of that. So my son actually approached me the other day and said he wanted to get into NFTs. And yep. Yeah, it's I don't know. I don't know enough about it to speak intelligently, but it was weird to me. It was like something you never heard of, and then all this it like branched out of the Bitcoin conversation in the sorry, not never heard of, hit the spotlight last year. Yeah, okay, sorry. I'm using my own frame of reference. I had never really heard much about it until I think it was like last year. Right. Yep. And then you get the piece of art in exchange for it. Yeah. Interesting. I'll have to do more research on that. Yeah. Thank you. Thanks for coming. I appreciate it, especially in the middle of the day. Thank you. Also, most people were nice enough to not do that while other people were still asking questions. So, hey, by the way, are you guys all from Westport? Josh and I were